Steve Liesman, CNBC. Thank you, Mr. Chairman. Can you explain how the stock market being at and near all-time high, corporate spreads being very tight, how does the level of the market factor into your decisions to raise interest rates? Is there a concern on your part? And then as sort of a second and related part, can you tell us what happens in 2020 and 2021 that, I know you can't tell us, we were shaking your head, that prompts you, the Fed, to think that the rates need to still be above neutral in that time period? Thank you.
Sure. So in terms of financial markets and monetary policy, as we say in our statement every cycle, we do take financial conditions into consideration because broader financial conditions do affect the broader economy, and they're one of the many things that we take into account. The part of it that we control, though, is what we do with the federal funds rate, and that has effects out through through the full interest rate curve and into financial asset prices generally. So the answer is we take everything into account, but and broader financial conditions are just one of the things that we take into account. In terms of 20 and 21, your question was why the funds rate needs to be above neutral. So you're right. Some of the participants have mostly very modest overshoots of their personal estimates of neutral, a couple 3 years out. It's far out into the future. I think it's hard to be confident that that's the way things are going to be. What we're going to be doing as we go through time is asking at every meeting whether monetary policy is set to achieve our goals, and I think that's an assessment of where policy will need to be some years down the road, and I'll leave it at that.